Taikaho. I'm Ray Irving, and I'm FS-ISAC's Managing Director for Global Business Services. FS-ISAC stands for Financial Services Information Sharing and Analysis Center. And we are a global consortium dedicated to the resilience of the financial services sector through information sharing, where we act as a sort of neighborhood watch, sharing information between our member firms, and also through resiliency and exercises in helping plan to coordinate during an incident. So today, I'm going to be talking about changes that are happening in financial services. I'm going to do a little tour of some of the changes that are really happening in the sector in recent years. There's a lot of change taking place, and there's really three primary drivers for that change. Technology, where we're seeing some interesting innovations in technology coming along. And I'm going to look today at cloud computing and artificial intelligence in particular. Regulatory changes, where regulators are passing new legislation and encouraging things to go in a particular direction. And I'm going to touch particularly on open banking, operational resilience, and intelligence-led pen testing. And also innovation, where we're actually seeing new ways of doing things coming out, new technology and business practices. So I'm going to talk a little about the fintech world, and particularly about just drill down a little bit into challenger banks and peer-to-peer financial services. Now, all of this is happening against the backdrop of a pandemic. COVID-19 pandemic is still going. That's why this is a virtual conference, not a real conference. And that has been acting as an accelerant or a catalyst for all of the changes that are taking place in the sector. So COVID-19, huge changes to working practices with massive amounts of digitization that have been driven by the arrival of the pandemic. It wasn't normal to do virtual conferences a couple of years ago, but now it is. It wasn't normal for large numbers of staff to be working remotely from home for months on end in the past, but now that is happening. So massive changes there, and also changes in the adoption of the technologies. For example, grandmothers are now having to do internet banking or mobile phone banking because they just can't go down their local bank branch because they're sheltering. So big changes. We did survey our members last year during the height of the pandemic to see how that was affecting them. And here are some of the results. 75% of our members said that they were making significant changes to their cyber programs as a result of the crisis. And we'd really expect that, because if you're going to move to a much more digital footprint and more digital ways of doing things, it stands to reason you're also going to have to adjust your cybersecurity posture in order to properly protect those new developments. Only 3% said they were needing to make changes to their digital banking tools, which tells us that those capabilities already existed, were already there, and in most cases were fit for purpose. They're just going to see more use now. 11% were concerned about third-party risk, more concerned, that is, as a result of the pandemic. And we would understand from that those are the people who are really worried about where they've got, for example, outsourcing arrangements in countries that are heavily affected by the pandemic, and they'd be worried that those outsourcing providers might not be able to provide effective security during the pandemic. And interestingly, 46% are expecting to see more investment in cyber after the crisis. So what this is telling us is that we're seeing a state shift here. We're seeing increased amounts of digital practice and working, and that in turn is going to force increased investment in cyber, because the more your business footprint is in the digital world, the more you're going to need to protect that business footprint. So let's talk about some of the technologies that are coming along. First of all, cloud computing. There's a lot of drivers for cloud computing. Cost reduction is a main one. It's potentially possible for you to leverage the huge economies of scale that the cloud providers have, and even after they've taken a cut of the profits, they can pass some of those savings on to you, so that can be a win-win for everybody. Secondly, it's fast and flexible. If you've got a credit card, you can buy yourself a server online, a virtual server, very quickly, and have that provisioned within minutes, which certainly isn't the case when you've got to provision that in your own data center. When I was a project manager in the past working in large financial firms, it would take us weeks to get a server up and running in the data center with all the different things that had to happen. And it's also an opportunity for you to modernize and standardize your business processes. You can you're moving things to a new environment. It's an opportunity to take another look and start from scratch with ask yourself why various practices that have evolved over time and maybe no longer make sense are, and perhaps find new ways of doing things. Obstacles is really all about control. Control and over the security of your data is, of course, a big worry. If you're putting something out in the cloud, you don't want it to be just a black box that you can't understand. You may not be able to control what's happening with your data. Regulation is also a concern. It's been the case that regulators weren't really very comfortable with cloud, and that if you were to put stuff in the cloud, certainly in the financial services sector, you would have to answer questions about why you're doing it and how you're protecting it. Those questions might be more trouble than the benefits. Integration with existing legacy can be tricky. If you've got some of your applications out there in the cloud and others in your data center, you're going to have to figure out how they're going to talk to each other and how data is going to flow between them. Performance and resilience is, of course, a question mark as well. And vendor lock-in is a concern. If you move to a cloud provider, are you stuck with them forever? Or could you abandon them if you became unhappy with their service or their cost structure? Now, the reality is that we're seeing 88% of our members in the United States, for example, now have services outsourced in the cloud. So people are moving to the cloud. And I'm going to drill down into that a little bit more in a minute. And cloud vendors themselves have been looking at that list of problems that we just went through, and they've been trying to turn them into strengths. So you, for example, can now get private hosting options in a lot of countries. Certainly, for example, Swiss banking, the cloud providers are starting to offer in-country hosting that enables Swiss banking data to be kept safely and legally. And that applies in many jurisdictions now. Secure hosting, if you buy it, the cloud providers are telling us your data is safer with them than it is at home, or in your own data center, which may be the case depending on your particular capabilities. Regulators are starting to understand it. Open source maybe eases products, maybe ease some of the worries about portability. And with regard to resiliency, there are a lot of packages now, so you can specify particular levels of availability and specify how data is kept. Rapid deployment, of course, is a big benefit, and there's a lot of opportunities for interconnectivity as well. So business data can be enriched, but with third-party sources. So, for example, if you're using Salesforce, there are thousands of firms that will integrate with Salesforce and enable you to enrich your own customer database with additional information. So the upshot of all of this is that cloud adoption is becoming almost mandatory for financial services firms if they want to stay competitive. You're going to need, your competitors are going to be going in there and taking advantage of those benefits and trying to realize them. And if you don't do the same thing, you're going to be at a disadvantage. So, quick member survey from FS-ISAC members. We've got roughly 12% of our members are still hosting everything on premises. Roughly 15% have outsourced everything, and the remainder, roughly 75%, have got a hybrid model. So basically, a lot of people have now moved to the cloud. What kind of cloud implementation? Well, that varies a lot. As you can see, some of those folks are using public cloud, some are using private cloud, some are using infrastructure as a service, and others are using software as a service. And many are using hybrids of that. So really, no one size fits all. Different firms are experimenting with different implementations according to their specific business needs. The next tech change that I want to talk about is artificial intelligence, which is also a big game changer. On the business side in finance, of course, it's changing all offices from front office to back office. In the front office, it's really important you can have, for example, artificial intelligence bots that will talk to customers online. You can have artificial intelligence biometrics that will help with identification and authentication. And you can have various AI insights into things. So for example, AI might be able to predict who is going to want to use a particular product and recommend it to people. On the middle office, it's really important in reducing risk, and particularly with anti-fraud, anti-money laundering, and knowing your customer. AI can help to spot things that are not as they should be in a way that is much harder for humans or normal algorithms to do. And in the back office, AI can help with credit underwriting, with smart contracts, by which I mean blockchain and other things. So there's a lot of potential there for AI to help smarter thinking and perhaps reduce the amount of humans that are needed to offer financial services. In cyber, AI, of course, is also helpful. You can take the load off your security operations staff by using AI to improve automation and to spot things that maybe before, for example, security events might be, you might have to predict them and program them into a SIEM. Maybe with AI, you can have those spotted automatically. And also during, for example, incident response, you might be able to have automatic responses that are driven by AI. So potentially it can be a big help to defenders where staffing numbers is always going to be a problem. We'd expect whatever the defenders can do to help automate defense, the attackers would also be able to do to automate attack. Now, I can't think of any really well publicized examples of artificial intelligence driven attacks to cite today, but that certainly looks like it could be on the cards, and we need to watch out for that because that's going to be a challenge for us as well. So having talked about technology changes, let's move on to regulatory changes. First of these is open banking. And that's a regulatory-driven attempt to liberalize and liberate customer data held by financial services firms by allowing third parties to access it using APIs. So in Europe, for example, that's the PSD2 directive. In Hong Kong, that would be the Open API framework. And there are many others around the world, as you can see from this map, that are coming on or are being thought about. And we're going to see big variations in the effect of these. Different regulators are doing them in different ways. I would imagine we'll see this start to stabilize over time as well as the effects are better understood. I'll talk a little bit about open banking from the in PSD2, which I'm most familiar with as a European. One of the big concerns, of course, is the whole question about these third parties. Can you trust them? What controls are there about who can be a third party? If somebody, there's obviously a fraud risk there if you're allowing your customers to allow access to their data through these APIs. You need to know that the people who are accessing those APIs are allowed to do it. And also you need to secure those APIs so that they're not used to perpetrate fraud by threat actors. Also an interesting legal liability question. How do you deal with a situation where, for example, a third party accesses an API and conducts a transaction, and that was actually a fraudulent transaction? Who's responsible? Is it the third party provider? Is it the bank whose API was accessed, or is it the account holder? So there's some interesting legal challenges which are going to take time to figure out and work through that. Also, in the case of PSD2, it doesn't necessarily seem to be a terribly sustainable model, as the providers are obliged to provide it free of charge. So they're not able to charge for people to access through the API, which would seem to make sense in the long term if it's going to be a sustainable model. So that's open banking. Another big regulatory topic at the moment, and it seems recently there's been a new paper on this every month. We've seen a lot of papers on operational resilience. Financial Stability Board have published one, Bank of International Settlements, Bank of England, and so on. So there's a lot of regulatory papers coming out about operational resilience. And what does that mean? Well, operational resilience is all about changing the way you manage risk. It used to be that firms would manage operational risk. They'd look at the risks and try to understand how much to lower them. Operational resilience is a different approach. You look at what your firm's doing, you ask what aspects of the business are absolutely critical, and you set impact tolerances. You say, how long can I do without this? And based on those tolerances, you set out to engineer those services so that they can resist any black swan events that come in, any serious incidents, and stay within those availability tolerances that you set. So you're flipping it around. Rather than looking at risks and trying to mitigate them, you're looking at what your business needs and trying to make sure that your business is going to get that business need if risks materialize. So operational risk management becomes a tool to enable operational resilience. This is a pivot, and you're going to be seeing more and more regulators are going to be picking this up, given that all the thought leaders are now talking about this. And I think it makes a lot of sense in terms of better understanding how to protect your firm. Now, during COVID, we learned a few lessons about resilience. As I mentioned earlier, a lot of CIOs and their teams were working late into the night to make sure that everything worked once we switched into lockdown and people were working remotely for the first time. And that was a big challenge the sector faced, which I think it passed very well. Capacities were increased, new ways of working were established, and also at the same time there were business challenges as well. For example, in some countries, the banks were obliged to offer mortgage interest relief or quick loans to firms that were at risk, or cash payments to citizens. So there's been a lot of unusual business requests as well, which firms also had to meet, and of course a lot of that fell on the CIOs to deliver as well. So I think the sector did well at responding to COVID. But we were lucky. If we think about it, COVID was an easy challenge in the sense that we could see it coming. It was quite predictable. We could see what was going to happen. It took days and weeks for things to occur. It wasn't an instant attack or a hit. Also, it's lasted a long time, which has given us time to adapt and to understand it. So it wasn't a case of something that happened for a day or two and then passed. But finally, it was symmetric, which means it affected everybody equally. So it wasn't like one or two firms were hit by COVID, but nobody else. This hit whole sectors and whole industries, which is, of course, easier because then the damage is borne by everybody equally. We can imagine a fast, short-lived, and asymmetric attack would be much worse. That could easily drive companies out of business, for example. One example of such an attack would probably be a cyber attack. We can imagine that a lot of cyber attacks would happen very suddenly. They would only last a short time, and they would not necessarily hit all firms. They might just target one or two or a handful. We can imagine complex operational failures in the same thing, or key third-party failures. So there is potential for much worse black swan events than the pandemic. And when we're doing our operational risk planning, we need to look at that and build for operational resilience that can handle them. Final change on the regulatory side I want to touch on is threat-based intelligence testing. So threat-based penetration testing. In the old days, we used to do vulnerability assessments and penetration tests to establish that the public services on the internet were properly protected. More recently, in the last few years, red teaming has become very popular, where you hire some good hackers of your own and charge them to go and try and hack into your own network. And that's a good way of finding vulnerabilities as well. And it's a bit more realistic than the pen tests and the vulnerability tests. But now, the threat-led pen testing, which has been encouraged by regulators, for example, in the UK, we've got Citibank, in the EU, we've got Tiber, in Hong Kong, we've got ICAST, I believe. They're encouraging this, and what you do is you take actual intelligence about what's really happening, about what real life threats there are, and you give those to the red teams, and the red teams use those to test the security of your organization. So it's really like a very applied and relevant stress test to validate your security defenses. And that's going to be a lot more valid and useful than the old way of doing things. I quite like this new innovation from regulators, and given, again, some of the thought leaders are championing this now, I would expect to see this spreading around the rest of the world as well. So we talked about tech change, we talked about regulatory change. The third thing is, of course, just innovation. Look at the history of banking. I won't go through this in too much detail, but basically, banking has been around for a couple of 1,000 years. We used to have Asian merchants who would lend money to farmers in 2000 BC, that's like 4,000 years ago. Back in the days of the Roman Empire, you could borrow money. There were mints in the temples, and money was well understood. Banking came along about 1,000 years ago. We had the Knights Templar running early European banks. We had, in Renaissance Italy, we had the Medici family and other merchant banks. And then exchanges came along a little bit later. London Royal Exchange was in the 1565, that opened. That was a goods exchange. And then the Amsterdam Stock Exchange opened in 1602. So, and then more recently, we see various banks being formed. And as a Brit, I remember the learning at school about the South Sea bubble, which happened in 1720. And that was one of the first financial crises. And there are other financial crises as well. The tulip bulb one springs to mind. So even financial crises, which we're all familiar with, are not a new thing. They've been happening for hundreds of years. So really, not much has changed in financial services if you take a 50,000-foot view. Now, fintech is not a business category in its own right. I put here the definition of fintech as defined by the Financial Stability Board, which I think is a good definition, if a little bit of a mouthful. But the key point here is that fintech is using technological innovation to develop new business models. But those business models are going to be associated with something that already exists. They're not going to be a new way, a new thing. They're going to be a new way of doing something that you've been doing for a long time. And here's the Bank of International Settlements fintech tree, which I really like because it fits exactly the same structure as this talk. I do recommend anything that the Bank of International Settlements put out. Do subscribe to their stuff if you're interested in financial services regulation. And this is from their FSI Insights on Policy Implementation number 23, if anyone wants to go and take a look at that. And what we can see is at the roots of the tree, you've got what they call policy enablers. And those are the regulatory changes I was talking about earlier. You can see they've specifically mentioned open banking. They've also mentioned digital identities, data protection, innovation facilitators, cybersecurity. The key point here is at the roots of the innovation tree, you've got some regulatory changes there, which are helping to enable things. On top of that, you've got the trunk of the tree, which is the technological changes I was talking about. They mention artificial intelligence and machine learning, which I also did. They also talk about the APIs which are used by open banking and cloud, which we've also spoken about today. Biometric, and DLT stands for distributed ledger technology, which is of course blockchain and all of that. So there's a bunch of enabling technologies on top of the regulatory foundation, which are enabling the actual fintech activities, which they show in their tree. And what you can see here is out on the branches, you've got all the various things that are happening in fintech today. And we all read about those, the robo-advised digital payment services, electronic money, insurance technology, business models, and so on. So those things are all happening out at the tips of the branches. But the branches themselves, they've been around for a long time. And going back to our history, they've been going on for hundreds of years. Deposit and lending, capital raising, that's something that's been happening for a very long time. Same for asset management, payments, clearing and settlement, insurance, and even crypto assets. I think if you went back to the Amsterdam Stock Exchange in 1602, I think you could quite quickly explain what blockchain was to a commodity trader at the time, and they would be able to understand that and very, very quickly. Rather than trading in grain or rubber or some other commodity, you're trading in a virtual asset that's been created by crypto miners. So it's actually quite easy to get your head around that. So just before we finish, I'm just going to drill down into a couple of particular manifestations of fintech. First of all, we've got challenger banks. Challenger banks are small, recently created retail banks that compete directly with larger banks. So I know you do have a bunch of these in Hong Kong, but not being familiar with the market, I'm reluctant to name them in case I get it wrong. But they tend to be funded either by venture capital or by large banks or other firms, and they're basically cherry picking in the market. They're using light, agile, technological approaches. Typically, they're online only, avoiding physical operations to keep costs low and complexity low and enable themselves to operate in the market. So, for example, in Europe, we've got quite a lot of them. There's a lot of banks now where you can just transact on your phone. You just need to download an app. Revolut, N26, Starling, and Monzo, the examples I picked out here. There are more. So it'll be interesting to see how these progress. I would guess that as is the natural order of things, they will if they're successful, they will slowly get absorbed into larger firms that will buy them up and maybe just result in slightly new ways of doing business. Another one that I really like is the peer-to-peer financial services firms. That's a way of disintermediating the big, gigantic insurance companies or banks and putting people on the internet in touch with other people in the internet who have to collaborate and to basically conduct transactions in a way that they just basically benefit one another. One example of that would be loans. If you've got some people on the internet who want to lend money and other people who want to borrow, you can potentially crowdsource that. So you crowdsource a loan rather than having to walk into a financial institution and convince your bank manager to give it to you. Insurance, similarly, you could put together a group of people who could mutually insure one another against loss. So potentially it would become a collaborative venture. And if there were no claims, that could be to the benefit of everybody because there would be no premium. And if there were, so again, insurance potentially could be peer sourced. Payments is another example. I've mentioned TransferWise as one of those. It's a firm that a UK startup actually, which will put together people in different countries who want to change money and link them up, thus enabling them to transact at the midpoint of the exchange rate rather than having the usual cut that you would see from transacting through a normal bank. So these kinds of things are interesting. It remains to be seen how disruptive they turn out to be, but there could be some interesting applications there, and technology makes this a lot easier to do than it was in the old days, where really the difficulty of finding other people who wanted to, if you wanted to borrow money, the difficulty of finding people who wanted to lend it meant that you were pretty much obliged to go to a lending house, whereas potentially with the internet, this sort of thing starts to become a little bit easier. So I hope you found that journey into the different changes and aspects of financial services during this pandemic interesting and useful, and you've got some takeaways that you might want to go away with and look into. And I'm going to wrap up our journey here just with a couple of contact information. If you do want to know more about FS-ISAC, I've put down Chris Wong, who's in our Singapore office. He also speaks Mandarin. So if you do want to get more involved with FS-ISAC, don't hesitate to reach out to Chris. I've also put my own contact details, of course, and you can also hit me up on LinkedIn and so on. If you do want to follow up on any of these topics or reach out to me, I'd be happy to hear from you. Now, with that, I'd like to thank you very much for your time and attention. Sorry that we're not meeting in person this year. I would have loved to have come to Hong Kong, but unfortunately, it doesn't seem to be the case. I'll have to look forward to doing that at a future conference. So thank you very much for your time.